Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow Advisors, and with me today is our Chief Investment Officer, Chance Finucane. And we've not done a joint session together, but we are doing that today because it's the last of the season, and we're doing that one with the title Past, Present, and Future, because I know most of you don't understand why this year is so crazy. And I've had so many comments this year from people that said, hey, I don't understand what's happening. I thought I understood investing, but I don't really understand. And this year's thrown everything awry. Before I ask Chance that question, though, I would tell you that there's one reason for all of this, and that's because of the Federal Reserve. They changed the game in March, not only by just by lowering their interest rates. That wasn't the really big picture. The big problem was they bought everything in sight and continue to do so. But speaking about extremes, Chance, what do you think?
Yeah, just focusing on the stock market, I think what we saw this year was really unprecedented, at least going back in 60 years of market history that I've studied. We've never had a period like this before where we went from investors being very greedy to them being panicked and fearful and then being back to greedy again, all in the course of 6 months. And I don't think we've ever had a timeline that short where you went from greed to fear to greed that quickly. But one other thing that we think was really unique with how this year played out, we've had a recession, but this was not your garden variety recession. A group that we use that we think does excellent work called Empirical Research, they were the first that came up with this theory that we believe to be true, that this played out more like a natural disaster. And what they actually did was they looked at private employment totals in Louisiana after Hurricane Katrina struck. And this year has played out very similarly on a national level, where we had a big drop in employment over the course of a month or two, and then a steady rise back towards more people in the workforce. That'll probably take about 2 years to play out, but that's very different from what you normally have in a recession. On top of that, I think what also was different was this year we had a lot of industries that actually did better than expected because of the way the pandemic played with the economic shutdown and some online businesses doing better than expected. It was only some isolated areas that were really hurt. And so it was areas like travel and experiences, some banks, and then some areas like energy and real estate.
Well, what we looked at, and we run 4 strategies. Chance is completely in charge of 2 stock strategies, which both did very, very well this year. And our conservative income strategy did very well this year, obviously, because rates went down so far. Where we were affected, and you'll see where oil going from $60 or $62 to zero or below zero, you can't fight that. That's one that really affects you. And I think we had more selling this year in oil than I've ever seen since I've been in the business. And the second portion, which is normally a very stable piece, is that real estate got hit hard. The real estate investment trust came down significantly, and in both of these cases, they've not recouped for the year. They're not like the stock market. While they offer significant income, they don't give us what we really would like to see in terms of price increase, and so we'll have to see that going forward. But Chance, you might talk about the equity portfolios did so well. Why was that?
Yeah, I think we feel fortunate and we're thankful that in such a trying year that our equity portfolios have done as well as they did. I think we can attribute it to a few characteristics. The first 2 relate to, we want to try to identify companies that are more in control of their destiny than the average business you could invest in. And there are 2 characteristics that we think really shined through in a chaotic year like this. And a group called Sea Funds posted a couple of charts here. The first focuses on really excellent businesses that deliver high returns on invested capital. And if you see on the right side of that chart, it was the businesses with a greater than 20% return on capital that did best this year. Now, a 20% return on capital basically means that for every $100 that a business owner reinvests into their company to open a new store or a new plant, they would expect at least a $20 increase in profit from that $100 investment. So for us, more than half of the companies that we own in our long-term growth portfolio are businesses that have a higher than 20% return on capital. The other piece was businesses that had strong balance sheets did really well, which has always been a focus of ours. And specifically, companies that had net cash balance sheets, which is more cash than debt, also did the best this year. And for us, 10 of the 21 companies in our long-term growth portfolio have net cash balance sheets. And we think that's actually an area that can be taken advantage of for an investor these days, and that we have these fast-growing tech companies that do generate profits, if you look at the large ones, that also generate so much cash that they have extra cash on their balance sheets. So when something happens, a disruption like we had this year, we know they're going to be fine. And other investors know that, and that led their share prices to be in better shape. The other area that we think was really valuable for us is a focus on trying to invest in companies that can actually meet their earnings expectations. I think you can look back at 40 years of history and you've seen that at the start of the year, Wall Street analysts will always try and come up with an estimate of what is the aggregate earnings per share we should expect for the S&P 500 or a European stock index. And it's always almost comical how bad these estimates are. If we look back just in the last 13 years, every single one of the last 13 years, the estimates have been too high for earnings per share in Europe. And in 11 of the last 13 years, they've been too optimistic about earnings per share growth in the S&P 500. So for us, we're trying to find companies that can grow at a faster rate than average, grow at a double-digit rate, but are actually going to deliver on those expectations. So we have a chart that we like showing where we can see in the holdings that we have in long-term growth that they can grow at a double-digit rate year after year after year and follow through on those expectations. And in the meantime, the S&P 500 is going to be all over the place. They only grew 1% last year. They were down 15% this year. And there's high earnings growth expected for the next 2 years, but we know that that's probably going to be too optimistic. And the piece why this is so important to us when we look at these years all together, if you're investing in stocks over a 10 or 20 or 30 year period, it's going to be the growth in earnings of the companies that you're invested in that's going to drive most of your share performance. So if you want to do that, you need to focus on companies that can consistently deliver over time. We have another chart that shows that over the next, just looking at these 4 years, we've got much faster growth from these companies than we do if we just look at the choppy growth in the S&P 500.
Well, and I think that gets back, and we'll talk about that a little later, about where to find income now, because on the dividend growth portfolio you run, that's another one where you're always looking for increased dividends as well as increased growth. But when you look at income today and you look at the bond market, one of the things we see today is that investors probably don't realize the risk in the bond market today. And we've been big bond proponents now for really the last 15 years. But where we are right now, and you'll notice this, that if you look, there's about $18.5 trillion worth of negative yielding bonds. And just to make sure everybody understands that, that means you get back less than you give. That's worldwide, $18.5 trillion. In addition, if you look at countries like Italy and Greece, Portugal, that have negative yielding bonds, and they're negative yielding relative, that means they're buying those bonds faster than they're buying the U.S. Treasury bond, which is an incredible number. And then secondly, we see rates rising. You'll notice that when you see this, that from over the last 3 months to 4 months, you've started seeing the 10-year Treasury rate go up. It was about a half point, 0.52, and it's gone up to about 0.92, 0.93 today. We think that's going well over 1, and I think people probably don't realize that. And the second thing is that bonds versus inflation, when you start to get inflation, which we think we're seeing more of, you're going to get a situation where those bonds are going to get hurt in that particular scenario. You'll find that you'll see we have a position now in the conservative income and the high income in the U.S. Treasury inflation type bonds. I suspect will increase as we go along. But so that gets me to this question, which is the standard Wall Street look over the last 15 to 20 years has been, well, let's just do a 60-40 portfolio, meaning 60% stock, 40% bonds. So we're starting to impose some problems on that look. What do you think about that?
Yeah, it amazes me to see when we look back about 40 years to see just how well that portfolio has done for investors. We always knew it was a balanced portfolio. The bonds offset the volatility of the stocks, but you were getting such a good yield on the bonds over these last 40 years that they really complemented each other very well. But we think today it's a little bit different, and I think you found a great chart on that that just shows the starting valuations that we have today usually leads to a difficult environment, especially if inflation may be increasing.
Well, and I think what happens too, if you look back over what we think is going to happen now, is the 40 side of that equation is so low that you can't get a number out of it. And you might talk about what you think on the 60 side of the equation and where you think that's headed over the next 5 years.
Yeah, we saw a number. There's a group called Wilshire Consulting that advises a lot of the large pension funds around the country, and they came out with an estimate for future returns in both stocks and bonds over the next decade. And we thought they were pretty fair. They're pretty reasonable. And for stocks, they only estimated a 5.5% average annual return in stocks for the next decade, which, given where starting valuations are, we think that's more reasonable to expect rather than historically you might have been able to get 8 or 10% a year. But if your starting point in stocks is 5.5% and bonds is going to be below 2%, given where yields are, the 60-40 investor today is going to make more like 4% a year over the next decade rather than the 10% they averaged for the last 4 decades.
Which poses a problem for the average Wall Street firm or average money management group, because they really don't make any. It's been a long time since they had to be in a position where they had to do something tactical, which was raise cash at market highs and take cash and put the cash back in at market lows. We've had periods before where you've gone 10 or 12 years like that where you had to really know what you were doing. I think we're going back into that same period. I know we carried significant cash levels this year, and people look at it and say, well, that's wrong. Well, it may have been looking backwards. The problem is, in order for you to have an insurance policy on significant volatility, you have to have some liquidity. You can't beat volatility with no liquidity. It won't work that way. So looking ahead, and we want to think about, so where would we look in what would happen? I think on the income side, people are going to have to adjust, because if you look at financial assets today, they are not paying you anything. The money markets pay you nothing. The CDs pay you nothing. We're in a situation the treasuries pay you nothing. And for example, a 0.7% yield on a bond is in a tax-free bond for 10 years is not very much money. And if you'll notice too, when you're starting to get those really low yields like that, when you measure that against the inflation number, the 1.6% consumer price index, you're going backwards. That's a problem when you're going backwards, because you're not keeping your buying power intact. So we think you're going to have to look at hard assets, something beyond financial assets, meaning you're going to have to take some risk in order to get some income. I don't think people are ready for that, probably, and they'll miss this. I think they'll miss that portion of it. But that's where we would see the income side going forward. What would make you look at, on the stock side, what would you look at that would make you want to put more money to work?
Yeah, I think so. Right now, our cash levels in the stock portfolios are a little bit higher than they are on historically have been. But I think that's just because we're not seeing much in the way of opportunities. I think we have a pretty simple system for when we want to put that cash to work. We've done this in the fourth quarter of 2018, and we did it in March of this year. When we start seeing the companies that we would like to own someday, we've got a list of about 200 companies that we think are high quality that we would like to own if we could get them at the right price. When we see those companies trading at prices that we think our investment would double in value in 5 years or less, that's when we want to put that cash to work. But right now, we have forecasts for all of these companies. Not a single one of these companies that we don't already own is measuring up to that level. So that tells us that we're just going to continue to wait until those opportunities come up in the future.
So I think what it leads us to look at right now is, while it seems like 2020 was a year where, you just had to stay the course for a couple of months and we're back in the money again. I think the problem with that is eventually the Fed goes away. I mean, they won't be there supporting all these assets. I know they're continuing to say they do that, but I think the risk in 21 will be, as you go back into a deep dive at some point, because you don't have anything supporting that. And we're not trying to scare people today, but just trying to say that, look, we're in a situation now where bonds are perfectly priced and stocks are perfectly priced, and there's nowhere to look for this really, really deep value other than a couple of places like we mentioned before, like energy and possibly real estate. But I think people need to keep that in mind going forward. But what would you say in closing on the stock portfolios would be what you want people to keep in mind for the next 1 year or 2 years?
Yeah, I think, look, we don't know necessarily what could create even more volatility than what we've had in the last 12 months. But we know with where prices are, it wouldn't take much to spook investors that are already thinking that everything is going to go smoothly for the next year or two. So for us, we're keeping that cash available in case there's better opportunities. We like what we own, and the reason why we like that is because we made an emphasis on quality and on companies that generate lots of cash flow and can control their own destiny. And so we're going to sit with those until we see something better develop that we can add into that portfolio.
And I think you could mention that we are not in the mode of chasing SPACs and that sort of thing, and these stocks that come out every day that really have no basis for trading where they are. And you'd have to agree, I think, that the speculative activity, at least from my vantage point, and this terms in the business, I've been there a long time, the speculative activity is extremely high right now.
Yeah. We actually, I saw this stat yesterday that there are 19 companies so far this year that have doubled on their first day of trading when they IPO'd, which is the most number of companies that have done that in a single year going back to the dot-com bubble.
So I think in closing that we would like to tell people is that, we're very cognizant of where we are right now relative to what's happening in the economy and what's happening in the market. And I want people to understand that it's not a perfect world, and that this is one of those times when you really need to understand the level of risk you're taking, not only in stocks but in bonds. I think we do that at Oxbow. I think we've done a good job. I think the whole group does a great job at that. And I want to thank all of you for everything we've done this year and the people we've interviewed this year. And so look forward to next year. We have some really exciting people lined up for 2021. And Chance, thank you very much as well.
Yeah, that was a good year.
So thank you very much, and we'll see you next year.